You're listening to The Real Investment Show.
And welcome back to the show this morning. John Penn, good morning.
Good morning. How are you?
Good. About a year ago, back in almost coming up on exactly a year ago, July the 9th, I wrote an article entitled, Why Am I So Lucky? Talking specifically about the cautions of private equity. Now, just quick recap, if you're not familiar with what private equity is. Private equity are investments that you can make and things that are not publicly traded. So they're not liquid. They don't have an open market. And private equity is a very good way to generate well above average rates of return. And can, provided they're done correctly, right? You invest in the right funds. You know, a lot of these private equity funds can generate somewhere between 14 and 18, 19% a year, depending on the fund, what they're invested in, et cetera. So obviously very lucrative. A lot of high net worth investors, they really like private equity. If you look at, like, for instance, Tiger 21, which is this kind of big investor group of really rich people, you know, they have about 20% of their portfolios invested in private equity because they can generate above average returns. And this is the story, right? I get above average rates of return with a non-correlation to the stock market. So stock market can go up or down, do whatever it wants to do. Private equity is going to do a different thing. So Lance, what do you mean by private equity? Well, you know, who does private equity? Well, there's a ton of private equity companies out there that do this, and they raise billions and billions of dollars to bring companies public, like Uber, Lyft, variety of others. I mean, you pretty much think about most of your public companies today that are trading, Palantir, all these, they all started as private equity at some point. So, you know, some company, you know, John and I go out and create a company. We're selling, you know, widgets, and our company's doing really well on a private basis. A private equity company will approach us and say, hey, you know, we'll invest, you know, we'll help you leapfrog in your growth. We're going to invest in your company, you know, $1 billion, whatever it is, and we're going to help you leapfrog the growth in your company. And then eventually we'll take you public, and that way we can get our money out, right? And then you'll be a publicly traded company, and you go on your way. And that's how most companies in the last decade have become public. They've gone through this private equity transition. So that's very lucrative when you think about it, right? So if you could be, as an example right now, there's a bunch of people raising capital right now for SpaceX, because SpaceX is going to go public at some point. So just think about how much money you could theoretically make if you could buy some shares of SpaceX today, and then those shares go public and they pop at the open and they go up, you know, 50% at the open, as we've seen with some IPOs in the past, right? So you could make a lot of money really quick, and that's what private equity companies bank on. So understanding that, and of course, there's also private equity, not just in equity like corporate equities. There's also private equity in real estate, private equity in just about anything you can imagine. Private equity's got their fingers in the pie somewhere. So they're there. There's a ton of capital. In that article, as an example, hold on, lost my page. We kind of talked about the overall allocation. So this was a chart from Long Angle, which kind of shows you high net worth investors and how they allocate to investments. And, you know, you can see that, you know, you have these, you know, kind of public equities, that's your stock market, your private equities, that's private equity, right? It could be their own business. It could be a variety of other things. But this is why these things are important. And so now the kind of the push is to make this thing available for everyone. And you have to start asking yourself the question, and this was the title of the article, well, why am I so lucky, right? Why do you want to make all this public? You know, why do you want this available to the overall public? Now, prior to this, you had to be qualified as an accredited investor to invest in private equity. And so you would, if somebody approached you and said, hey, I've got a deal for you. If you can just fill out this form for me, don't care if you lie. But you've got to say you're worth $1 million, or you make more than $250,000 a year, or $350,000 joint. to qualify as an accredited investor to make an investment into those PE. The theory is that if you've got $1 million worth of net worth, you're at least smart enough to understand risk.
Well, and you also have some liquidity, because if you put some money into private equity, you got to make sure that you've got some liquid assets around it too. So that's also an assumption.
Yeah, because
right?
the other problem is you get capital calls. We'll get to that in a minute.
Yeah.
Get to that in a second. So the SEC right now is the commissioner, Hester Pierce. Not that she's not owned by Wall Street. Recently explained why she thinks the accredited investor standard should be eliminated, and which would make it easier for retail investors to access private markets. Now, just set all this stuff aside. Set aside for a moment everything that we just talked about private equity. Tons of risk to it. But let's just talk about supply-demand dynamics for a moment. I just told you a second ago that a lot of these private equity companies can generate 16, 17, 18, 19% a year with a non-correlation to the stock market. Part of that reason that you can generate outsized returns with private equity is because of scarcity. Well, I'm just going to leave it to you for a second to think about this. If I make private equity, quote unquote, public, what happens to the scarcity of private equity that allowed you to have those outsized returns with non-correlation to the market?
Exactly. Yeah. Mm-hmm. Yeah. So there's a push, and she, Mrs. Pierce, not sure if she's married or not. Ms. Yeah. This is her opinion, and she did say that this is an opinion that maybe is not shared by others. Right, where she would like to see this rule of, in order to invest in private equity, she would like to see that accredited investor rule go away, right, and just make this available to kind of the general public, because her response was, she was sworn in commissioner in 2018, and she said, this is not a decision that everyone shares, but it's something that I hear a lot from investors. The investors, are very offended that the fact that they don't have a lot of money means they're shut out from a huge part of the market.
Okay, well, first of all, huge is not the correct term for private equity.
Great point. Right?
It's big. It's big market, but it's not a huge part of the overall market, right? So, but again, here's some problems with private equity.
Yeah.
So, Brent is not a good example because he's got millions stashed away from his long career of radio geniusness. But let's just say Brent's your normal average guy, right? And that Brent's got $150,000 saved up, in his investment account, et cetera. So they say, okay, great, we're going to allow you to get into private equity. There's a lot of problems with private equity. So first of all, there's a lot of cases, there's long lockup periods. So again, let's just assume that Brent's going to invest in SpaceX, right? Well, he can't get his money out of SpaceX till it goes public. So how long is that going to be? What if he needs some of that money? What if something happens and he needs some of that money? The other thing is capital calls. Mm-hmm. So a lot of times you invest money into a project and it's not going as, it's not taking off as fast as expected or whatever. And the company says, hey, we need to raise some more capital. Well, they come to you first and they say, Brent, you invested, you have, 1%, you have a 1% stake in the company and we're raising some more capital. So if you want to keep your 1% stake, you need to give me some more money, because if you don't give me more money, when I raise more capital elsewhere, your 1% is no longer going to be 1%. You're going to get diluted right out of the company because these capital raises get bigger and bigger over time. So lots of problems when you start tapping on to the little guy. It sounds great in theory, but here's the other thing. When you talk about private equity, you only talk about the successes. Oh, this guy, he invested. When you hear about, it's like, oh, here's Peter Thiel. He was the original investor in Uber or whatever. Ask him how many deals he lost money on. Because in a lot of cases, these deals don't mature. I need this chart, Brent. I cannot. Something funky's going on with the website today.
It's gremlins.
It's gremlins. Exactly. So here's the deal. These are the number of globally terminated M&A deals and PE VC-backed terminated deals from 2020 to 2023 by quarter. You'll notice that a lot of these deals get terminated. They just don't make. For instance, you're familiar with DoorDash and you're familiar with Grubhub. How many delivery companies started up that got PE funding that didn't make because DoorDash got the dominant market share? When that happens, you don't get your money back. So when we come back from the break, we'll talk a little bit about what the implications are for putting this and what kind of the goal is here and who's behind this push by the SEC to get rid of the accredited investor status. You won't believe who's behind it. I'm just telling you now, you're not going to believe who's behind it. It's going to be completely shocking to you who's behind this big push to publicize private equity. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
So as we're talking about, the SEC chairman is looking to get rid of the accredited investor rule and allow everybody to have access to private equity. Again, the problem with this is a couple of things. Is scarcity is what makes private equity valuable, as is always the case. And when you democratize it, as the kind of the buzzword is, we need to democratize private equity. All you do is make it a public market, and then it's not valuable anymore, right? Because everybody has access to it. I need this other chart, Brent. The other side of this is again, as we were talking about before, all you hear about in terms of private equity, because they make a lot of money, is you hear about their successes. You don't hear about the losers. This chart that I'm showing you right now, if you're driving, don't try to look at your phone. Basically is the percentage of deals done in private equity that provide a return of some sort. Running from, and I should not say it provides a return of some sort, because it also includes the companies that went to zero. 64.8% of companies generate a 0 to 1-time return. In other words, you put your money in and you get your money out. That's all you get. 25.3%, you get a 1 to a 5-time return. So that's not too bad, but that's only 1/4 of the time that you actually multiply your money. The ones you hear about, the Ubers, the SpaceXs, the Lyfts that generate, 50, 60 times, return on money, the big winners, that's 0.4% of the time. Now, let's talk about something else real quick. I'm going to read to you from a Wall Street Journal article. "The future ain't what it used to be for these funds," is the title of the article by Jason Zweig. With their words, the managers of private assets are telling investors that the best is yet to come. With their actions, they're suggesting the glory days already may be ending for private equity. Giant firms like Apollo, Blackrock, Blackstone, Capital Group, KKR, State Street, and Vanguard are all rushing to get individual investors to buy alternatives like hedge funds, venture capital, non-traded debt, equity, and real estate. Can't do that without whom? Who do you need to allow private equity to be sold to the retail investor? You need the SEC to approve the rule. So, like I said, can't imagine why the SEC commissioner is currently all for getting rid of the rule that's restricting retail investors from getting into private equity. But here's the other question you should ask yourself. BlackRock is a $10 trillion firm, right? Vanguard's huge. Why do these companies now need to be able to sell you private equity? Think about that for a moment, right? Why would these companies who have access to the largest sources of wealth in the world. I mean, Blackrock has every major investor, pension fund, you name it, at their disposal. When they want to bring a deal to market, whatever it is on our private side, they simply just kind of raise their flags and say, hey, we're doing an infrastructure fund, and money piles in. Why do they need to sell it to you? Or is there some other reason for this? Now, think about this for a second. I've got a deal on private equity side that I have SpaceX, right? So I'm going to go to all my private equity investors and I'm going to say, hey, we're going to take SpaceX public, so we're going to get y'all pony up, right? So y'all all put in, $500 million each, whatever it is, right? We're going to raise billions of dollars for SpaceX. Do you think that deal ever makes it to the retail market? Or I'm Blackrock and I've got a deal that's, I got to take this deal because of whatever reason. I just need to get a deal done, right? I've got to fund this real retail side of my private equity market. What deals do you think they get? Do you think they're getting the SpaceXs of the world, or do you think they're getting the deals? I need some place to just offload private equity that's coming through that aren't great deals. They're not terrible, but they're not great deals. Who do you think still gets the benefit of the great deals versus the retail investor? And of course, at the same time, when you're funding in just a lot of deals, now once this chute is open for retail investors, it means I've got to take every deal that comes along to fill the chute, good, bad, or indifferent. I've got to fill that chute to retail investors.
Yeah, you got to fill the appetite, right? Because once you start, now, they're even talking about bringing, private equity investments within, employer-sponsored plans,
right?
401ks, 403bs. I don't agree with it. I don't think it's a good idea. I just don't think it's going to bode well for folks who are putting money in their retirement plans, and the structure, the way the private equity would be structured within a retirement plan, within an ERISA-based plan, would look completely different than the private equity that you're talking about.
Right.
This private equity would be designed to offer daily liquidity.
It would have to be.
It would have to be.
Yeah.
But
you can't lock up a 401k plan.
You can't, but in its very nature, that defeats the whole point of having something in a private, illiquid investment that is designed not to be directly correlated to that of the publicly traded markets.
Right.
Right.
And what you just brought up there is also another big problem, is mark to market. In the publicly traded market, if I buy a share of Apple today, I know exactly what the value of it is because I just bought it from somebody else. We just had a live market transaction, right? So I buy 5 shares of Apple from John. John sells me 5 shares of Apple. We agree to a price. We have a value. Private equity isn't that way because it's not transparent, and you don't have daily transactions going on to set value. Interesting story. Hamilton Lane is a private asset fund. They're one of the first funds that have been put together to try to give investors bites of a lot of different. They're trying to build a fund of private equity investments. They have $3.6 billion in net assets as of the end of March. The fund is a fast-growing player. I'm reading, this is from Jason Zweig's article in the Wall Street Journal. Is a fast-growing player in the game of buying chunks of private equity funds in the secondary market. Okay, not primary market, secondary market. Those are off-market transactions. In other words, I call up John privately on the phone. And I say, hey, I'm willing to buy some stuff from you. Let's negotiate a deal. That's not reflected in the public market. In the first quarter, the Hamilton Lane Fund took in an average of more than $4 million a day from new money investors. Thanks largely to its remarkable performance is why investors are trying to pile in the fund. Counting a predecessor fund return since 2020, the fund has gained on average of 16% annually. Why would you not want to invest in the fund? Be careful. Like other such funds that invest in secondaries, Hamilton Lane Private Assets can buy private equity stakes from other holders, often at a deep discount to the official net asset value. Listen to that carefully. I'm buying shares from John at a discount to the net asset value that is publicly available, which was the end of the quarter statement filings, whatever. It then promptly marks up its holdings to that official NAV. By doing so, it disregards the discounted price it just paid, even though that price was set in a competitive auction. Do you understand what I just said? They're going out and buying assets on the secondary market in a competitive auction. They're buying them at a discount, and then they simply just mark them up to net asset value. That's your return. But if the shares were just bought, let's just say $1 million. I just bought $1 million of current NAV for $800,000. Is it worth $800,000 or is it worth $1 million? Because when eventually I have to sell that $1 million worth of value, do I sell it for $1 million or I sell it for $800,000? Because that's what it was worth when I bought it. But on your statement, you're going, hey, I'm making a ton of money here because I'm getting 16% annually, but you're not. As my continuing from the article, as my colleague Jonathan Weil exposed in the Wall Street Journal last year, this technique has sometimes resulted in 1,000% or more gains in a single day. Such maneuvers are legal, but if you don't think they smell a little bit fishy, I suggest you make an urgent appointment with an ear, nose, and throat specialist. We believe so. This is the problem with all of this stuff. It's not transparent. It's not liquid. And there's a lot of funny stuff that can go on behind the scenes. And again, you'll be thinking you're making a lot of money at this, but the statistics historically show that of all the deals that go through private equity, very few of them, it's a numbers game for private equity firms. They only need one at a 50 times return to offset the 64% that went to zero. The question is, are you going to be that lucky investing in private equity through your 401k plan or whatever in the future? And again, these things typically don't turn out well. I mean, we've seen this stuff before all throughout history. I mean, we saw SPACs just in 2020. How did the SPACs work out for you, right? We've seen this stuff before, and repeatedly, when Wall Street begins to feed on retail investors, it's typically the end of a run, not the beginning of one.
Well, those private equity investments too, these fund type of structures that they would want to weave into 401k plans, those typically have higher internal operating expenses or higher fees.
Well, that's a whole different animal.
I mean, I'll offer it to everybody. Sure, you want to buy this? Come on. Right?
Again, at the end of the day, just think about, this is great you're offering it to me. Is it for my benefit or is it for your benefit? Again, and again, I encourage you to go to our website, read the article, Why Am I So Lucky? If you're thinking about private equity, I suggest you read the article before you get into private equity, because the question you should ask yourself is, why am I so lucky to have this opportunity? And is it really that you're just lucky, or is it for somebody else's benefit? Be right back. We'll wrap up the show. John Penn, don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
And welcome back to the show this morning. So, another thing we're talking about this morning is, kind of new investment offerings that are coming into markets, et cetera, that, everybody's looking for something to sell to investors, especially when there's a lot of FOMO in the market about missing out on returns, et cetera. There's always somebody looking to gain an edge somewhere to make money, right? If you're willing to throw money at something, I'll sell you a product. And so we see this, quite a bit with SPACs, IPOs, all this type of stuff. When there's a lot of demand in markets by investors, that brings a lot of new products to markets. And one of those now is funds that are now promising shelter from wild swings in the markets. So in other words, these are, equity hedged funds or ETFs. And I get a lot of questions about these, like, oh, look, I can buy this, this put call cover ETF, whatever, provides a 12% annual dividend. It's great. Problems with all these things, right? They work some of the time, and then unfortunately, when you need them to work the most, they typically don't. And the problem is that most of these have not been battle tested. to any great degree yet.
They just haven't been around for a long time.
Yeah.
There's just not a lot of data to go back and look to see, how have these, behave during times of more, times of market stress.
Yeah,
right?
we had since these have been coming out. The last real market stress we had was the pandemic in 2020, and these funds weren't around then.
That's right.
So you can't go back and look at how did they perform during the pandemic because they weren't there.
Yeah.
Yeah.
It's just hard to, as of some of the most recent volatility we had just a couple weeks ago in April. I mean, one of the hedged exchange traded funds, that's an Invesco S&P 500 ETF, hedged ETF, has about 100 million in assets, and its goal is to achieve positive total returns in rising or falling markets, right? So, for the year so far, it's through yesterday, it's down close to 6.5%, right?
And the market's up 2.5.
And the market's up, 2.5. So right now it's kind of working against you here a little bit, right?
Well, again, this is, and whenever you add, and look, there's nothing wrong with that.
Yeah.
Mind you, right? There's nothing wrong with that. But what you're looking for is, whenever you hedge a portfolio, you're going to give up some gains. So you can't look at a 100% equity portfolio and say, this is how I'm going to perform in this hedged fund because you've added a hedge, and the whole hedge is to limit that drawdown risk. But the problem with a lot of these hedge funds is their performance is worse than just running a stock and cash portfolio.
Right.
Right, or stock and bond portfolio. Than just using cash or bonds to hedge your portfolio. They perform worse over time. And again, the problem is once you start throwing in options into these that's how they're hedging, by the way, is through the use of option strategies. You have time decay of premium, which that premium, what they call a premium roll, when I have to roll from one contract to the next, eats away at returns over time, and it's cumulative. So, a lot of these funds are going to more dramatically underperform over longer periods of time, simply because of that option roll and optionality within the underlying structure.
Yeah, I think there are times, Lance, where folks they're looking at these types of structures or these types of vehicles where, they're kind of looking for the, I don't know if I should even say it, kind of the holy grail of investing, where I'm going to put my money in this investment. I'm only going to be subject to upside returns without any downside whatsoever. And even these structures that are designed to provide these hedging strategies, they're not immune to market pullbacks. But I think sometimes as investors, we go into this expecting, well, if markets get volatile, hey, I'm not going to lose. I'm not going to have any sort of erosion to my principal.
That's not true.
And that's just not true.
Yeah. Right. No, we saw that, one of the JP Morgan equity hedge fund, right? When the market was down 15, it was down 11, right? Yeah. So it wasn't down as much as the market, but you're still down 11 versus 15%. And we'll tell you, John and I can tell you, that when the market was down 15%, our portfolio was flat for the year, and we had panic clients calling up going, oh my God, I'm losing all my money. And we were flat for the year. We had no drawdown in our portfolio at that point. Market's down 11, 12, 13, 14, 15%. Our portfolio is flat for the year, and they're freaking out because they're looking at the markets, not their portfolio. Yeah,
they're looking at all the narratives, looking at all the headlines, and not taking a step back to really look at, okay, well, how am I doing compared to all the noise that's out there, right? And here's the other, and I'm not saying that these hedged investments are bad.
Not at all.
To Lance's point, they're not bad. You just, before you incorporate this or these types of structures in your portfolio, you just have to get an understanding of how they work and how they might, potentially behave, right? So, but here's something else you have to think about. So these are designed to provide hedges in more volatile markets. That's assuming that investors that own these are going to hold these investments through this volatility, right? Because let's say markets get volatile, and let's say I'm going to pick on the JP Morgan hedged equity fund. I'm just picking on it because it's right here on my notes. Well, if that starts pulling down, and if I own those shares, my inclination is, well, I'm going to sell it. Well, I'm going to sell my shares. Well, then Lance sells his shares, and then Brent sells his shares, and all of a sudden you're selling. So then you've got that downward pricing on that from selling pressure, and the folks out there that own these hedges, they're not holding them to allow them to do what they're really designed to do. And here's the emotions of investors coming in and kind of maybe derailing what that strategy is intended to do.
Right. Well, and again, it's just, again, that's all of these.
Yeah.
Right. Again, and again, the performance differential. Okay, so here's a chart. This is the JP Morgan. Again, we're not picking on any one fund. I just Googled JP Morgan. This was the first one that came up. So this is the JP Morgan NASDAQ hedged, and versus the S&P. And I can do it versus the NASDAQ. It doesn't matter. The performance will be the same. But you're not getting an outsized measure of performance one way or the other, drawdown or advance. So, again, when you look at your portfolio, yes, it may be providing you a yield. That's fantastic, but but that yield factors into the overall performance, which isn't any different than really just owning the S&P 500. And you're not really reducing risk all that much. And again, nothing wrong with these at all. We're not saying anything's wrong with these at all, period, end of story. If you want to own them, that's fine. Just don't have the expectation that if the market goes down, you're not going to go down. Because you are going to go down because, again, what drives price? What drives price is the supply and demand of buyers and sellers. And when people start to sell, particularly like we saw in April, that was basically just a panic liquidation. Everybody was just dumping everything. And so eventually you run out of stuff to sell. So you sell your Apple and your Google first, and then you work your way down. It's like, well, the only thing I've left to sell are my hedged equity funds. I'm going to sell them too because they're going down. So what was the point of the hedge?
Yeah.
Right. So again, just be careful. Just because something's labeled in a certain manner doesn't mean that it actually is going to, perform the way you expect. And, when we all hear about hedging, we all think it's like, oh, I won't have any downside risk at all. That's not the purpose of hedges. A hedge just minimizes the drawdown risk to some degree. It reduces, I shouldn't even say minimize, it reduces the drawdown risk to some degree. Again, 11 versus 15, much better. Right, that's good. Still down 11% from that peak, but you weren't down 15. So you did reduce that drawdown risk somewhat. But again, when you hedge, you also have to expect to give up returns on the upside as well.
Yeah, and so thinking about that, like that JP Morgan hedged equity, so it was down 11%. Markets were down about 15. If you're a holder of that and you're like, hey, I can handle being down 11%. I'm not. This is fine with me. I'm satisfied. I'm only down 11. Markets down worse. Then it's the right investment for you, right? It fits. It fits into your overall strategy. But going back and looking at where we were in April, if there's a position in your portfolio, or if your portfolio's down, 11%. And that's keeping you up at night, well then, hey, that should be a sign that, hey, we need to really think about and reevaluate how much risk you're taking as an investor, right?
That's right. And again, it's just so again, just kind of wrapping that whole conversation up. Just there's all Wall Street is happy to sell you investments to make money. And they're the ones making money. They're charging you fees. They're giving you a really cool sounding investment. Just make sure you understand the whole point of our conversation. Just make sure you understand what you own,
right? Because
we can tell you from real time, client behavior that when markets are down, and again, when the markets were down 15, our portfolios were down 0 to 1 to 2, depending on the portfolio. Massive outperformance relative to the markets, and we still had clients freaking out, wanting to sell everything, go to cash, because they were convinced that the world was about to end because of narratives and headlines, and so, it's the deficit, it's the debt, and markets were selling off, and of course, as soon as markets rally back, it's like, why aren't we all in? So but just again, psychology. This is why we spend so much time on the show talking about behavior, psychology, all those type of things, because those are the things. The worst risk to investors is the investor themselves.
Yeah, I've had a number of folks as of late that I've been visiting with where we went through the drawdown in April. Now markets have rebounded here. There's been a number of folks as of late that have just admitted to me. They said, John, you know what? Hey, I just overreacted. I just overreacted a couple weeks ago. I let it get to me. And my answer is, you know what? We're human. We're wired that way. Money is emotional.
That's right.
At least you admitted it.
Exactly.
Which I appreciate.
Which now we can start to solve the problem.
That's right.
Exactly. All right. Thanks, John. Appreciate it.
You bet.
Get by the website, realinvestmentadvice.com. Our daily commentary is out. Our report out yesterday on how to buy the dip is on the website as well. Also at our Substack, at Lance Roberts on Substack. Make sure you subscribe there as well. Get all of our daily reports delivered right to your email box. All right. See you back here tomorrow.